My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Tough days don't last forever. But when they come along, you need to know how to respond. You need a game plan totally developed and ready so you can decide what kind of sell-off we're dealing with. I wish I could say that we always know how to respond, but the early days of the decline, well, they're never easy to navigate. First, let's borrow a line from Tolstoy's fabulous Anna Karenina. All happy rallies are alike. Each sell-off is unhappy in its own way. It's so true. Bull markets send stocks higher, and everyone thinks they're a genius for participating in them because it seems so darn easy. Big declines? Much harder because they could be the start of a bear market. They could be just the beginning of something unfathomable, or they might actually be a buyable glitch. That's why I want to use history to try to identify some of the common qualities so that you can figure out how to handle these inevitable moments of weakness without panicking. First, let me offer some historically constructive words of relief, sanity, and real, not phony, but real assurance. There have only been two truly horrendous sell-offs since I started investing in 1979, the one-day crash of 1987 and the rolling crash of 2007 to 2009. I could have done the NASDAQ crash, but the S&P held up pretty well. Let's deal with these two big ones, though, head on, because these two declines are great examples. They're polar opposites of each other, even as the percentage declines were somewhat similar. On October 19th, 1987, Black Monday, the Dow fell 508 points, or 22% in a single session, 22%. I was trading that day, and even as the previous week had been one of the worst weeks in market history, Monday hit fast and it hit hard. It was almost as if there were no buyers to be found, from Dow 2,246, where the crash started, to Dow 1,738, where it ended that day. It was selling off right into the close. I remember thinking, saved by the bell, except it felt like there weren't many left to be saved. What most people don't remember, as I mentioned, is that the week before was one of the market's worst weeks ever, as the Dow had already plunged from Dow 2,500 to 2,245. That's a 10% decline. That encouraged bargain hunters, and it turned out to be classic bad money in retrospect, because these intrepid souls thought they could flip Monday morning into some strength, and that strength never developed. In fact, the weakness that they were buying occurred the next day into what became known as Terrible Tuesday, where the Dow actually kind of just broke down. The market simply stopped functioning. But you know what? I was there, and I was actually able to calculate that bottom, the actual bottom that occurred, and it was around Dow 1,400. That was off another 338 points from where the market closed on Black Monday. Then Fed Chairman Alan Greenspan stopped the decline in its tracks when he said he'd provide all the liquidity necessary to stabilize the market. I still remember that green line when it came over your screen. Whew. He enlisted multiple firms around Wall Street to help put in the bottom, and the market staged a remarkable two-day rally that took us up more than 500 points. The effects of the crash lasted for 3 months, when we had a retest that held. But you know, it took almost 16 months until the averages returned to where they were trading before this big breakdown. The bear market that began in October 2007, it was totally different animal. The Dow fell from 14,164, and it didn't bottom until March 9th of 2009, when it landed at 6,547. We didn't return to that hallowed 2007 level until March of 2013. Why did one sell-off end so quickly while the other took 6 years to unwind? That's the question that defines the two extremes of unhappy sell-offs. The initial one, Black Monday, was a mechanical sell-off. The first one I can remember that occurred simply because the stock market failed to be able to function. It's instructive to unpack Black Monday because the way it played out was reminiscent of two other crashes, the flash crash of 2010 and its doppelganger in 2015. You may have heard theories about what caused these three crashes, but most of them are wrong, okay? All three started with the stock market futures, the S&P 500 futures in Chicago, overwhelming Wall Street, New York, where the stocks underneath are traded. Black Monday happened because stock traders didn't understand the power of the futures market, which could flood the stock market with instant, unseen supply. supply. These days, we accept that the futures are worth watching. But it wasn't like that back then because they were relatively new instruments founded 5 years before the crash. The power of the futures snuck up on the people because they were initially a much smaller market than the stocks themselves. Because of their great liquidity, though, the ease with which portfolio managers can go in and out of them, they became the most powerful drivers of stock prices, even more powerful than the actual performance of the underlying companies that stocks are meant to represent. Underlying companies' earnings used to mean much more. Now it's really these futures that matter. The thing is, even with the relatively new impact of futures, Black Monday was unusual. We had a big run going into 87. It was a remarkable multi-year rally with nary a substantial decline, and don't I know it. I left Goldman Sachs that year to start my own hedge fund because my returns had been so bountiful. The multi-year rally created such stupendous gains that a group of clever salespeople started selling what they claimed were insurance policies that could lock in gains and stop out losses for big funds. So-called portfolio insurance involved what was known as dynamic hedging. Oh, it sounds so dynamic hedging, where these specialists said that using futures, you could ensure that you would no longer be exposed to stock market risk, say down 5% or 10%, or whatever the policy you took out determined. The idea was that they'd let you sidestep the loss. I have to laugh. Sidestep the losses. It's impossible to do that. Unfortunately, much like communism, portfolio insurance is well conceived in theory, but it doesn't work in life. The losses all kicked in at once on Black Monday, and the insurance didn't work. If anything, the future selling from the insurance accelerated the decline and caused incredibly large losses for the actual insured. The people who sold these policies were charlatans and mountebanks. They were never exposed as such, other than just now. But that's exactly what they were. There's no magic trick that can get the returns from investing in the stock market without much of the risk. Don't believe anyone who ever tells you any different. Of course, at the time, we didn't know that the power of the futures could cause a crash. We figured where there's smoke, there's fire. If the markets crash, then there's got to be something real wrong with the economy. There simply had to be a recession lurking. There had to. At least that's what we told ourselves. Wrong. The economy was strong going into the 87 crash, and it was strong coming out of it. There just wasn't any economic correlation with Black Monday at all. It was the interplay between Chicago and New York that set off the conflagration. And when the Treasury Department examined what occurred that day in a huge report, it concluded the future set off so much selling that some specialist firms on the floor of the exchange and some brokerage houses failed to step up and stabilize the tape. The latter had no duty to do so, but the former were supposed to do it, and Treasury found that many didn't do their jobs. I was fortunate enough to be in cash on Black Monday, having liquidated my portfolio early in the previous week because the market had acted so badly. It made my career. For the next 14 years of professional money management, I could show prospective investors that I had sidestepped the crash for real. They thought I was a genius, but the truth is, I was just frightened of the market and wanted to regroup. But as I never tire of saying, it's better to be lucky than good. So here's the bottom line. Sometimes crashes have nothing to do with the economy. They're caused by the mechanics of the market. Stay tuned for more examples of this kind of decline and the more serious animal, the bear market of 2007 to 2009. So you can figure out what to do when they happen. Let's go to Keith in Texas. Keith!
Hey, Jim, how you doing?
I am doing well. How about you?
Pretty good. My question is, how do you decide when a correction like we had back in February has made a bottom and it's okay to get back into the market?
Well, what I like to do is I like to try to get a sense on whether the selling has run its course. And what it takes to do that is to be able, first, you get a level where it bounces, and then it comes back and it tests that level. If that second test, as we call it, holds, then it's more than likely that you have to come back from the sidelines and buy. Sometimes crashes have nothing to do with the economy. They have to do with the mechanics of the market. Knowing how to respond is essential to your money. On Mad Money tonight, my sell strategy session continues. Don't miss my take on the micro crashes that may be short, but could have lasting effects on your view of investing. Then, you might know Chicken Little and the Boy Who Cried Wolf from fairy tales, but they also play a role in the stock market. And is it all the Fed's fault? Not always. I'm eyeing the rational reasons that the market declines when it comes to the central bank. So stick with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.